In this video, we're going to talk about annual percentage yield and also some different types of saving and banking options and types of accounts that you could consider opening. So, annual percentage yield is basically a metric that financial institutions are required to report on all interest earning accounts. And the APY, as it's called, is basically a metric for how much you will earn in interest given if you invest or if you put your money into that particular account. So the APY adjusts for different things like compounding and things like fees to make comparing savings accounts easier between different banking institutions. So the formula is very similar to what we've looked at in the past with time value of money. We have 1 plus r, but in this case, it's divided by n to the nth power. So r is the same. It's the nominal rate. Let's say it was 10% a year, but n is the number of compounding periods. So if this 10% is given as a yearly rate, and if basically, so basically, if you deposited $100 for 1 year at 5% interest, and and your deposit was compounded quarterly, okay, so within that year, there's 4 compounding periods. At the end of the year, you would have $105.09. But if it had been just simple interest, where you're just earning 5%, you'd only had 105, right? So how did that math come about? Basically, we just used this formula here. We see that it's 1 plus r to the number of periods. So in this case, r is equal to, this should actually be to the fourth power. To the fourth power, or sorry, to the n, where r equals 0.05 and n equals 4. Okay, because again, this 4 is coming from this quarterly situation. If interest was compounded every 6 months, and this n would be 2. Okay, so when you plug in the numbers, you basically get this. Sorry, and this is to the fourth power, as I mentioned. Um, and then when you do the math, you actually get a slightly higher rate of interest as compared to this 5% because these extra periods of time within the year, you're actually earning a little bit of interest on the interest you've already earned. And so there's a little bit of that compounding effect that we've talked about within the year. Okay, so here's just a list of savings accounts. I would say that a traditional bank savings account is basically this right here. There's no minimum balance, and it's usually offered by most banks, all banks probably. And it's used for convenience because, again, there's no minimum balance, but the interest rates are usually really low compared to other potential options. And if it's at an FDIC insured bank, then you also have that insurance. This I don't really have too much experience with, but it looks like it's a checking account that pays interest on the balance. It's again probably going to be really low interest rate. And again, the savings account and the checking account, the funds are usually available right away. So that's why probably they're willing to pay you some interest on the checking account because just like the savings account, they're both funds that the bank would have to kind of immediately give to you if you needed it. Okay, a money market account is going to pay you a slightly higher rate. Typically, a money market, they invest in really short-term securities, which have a lower rate of return, but they're pretty liquid and usually there's no minimum. And a lot of times when you have a brokerage account and you have cash in the brokerage account, they usually put it in a money market fund. So you may see this if you ever open a brokerage account where the cash that you have in the account is in a money market and asset management account. So this is usually for like higher dollar amounts, and it's like basically a large. It looks like it combines a number of different types of accounts and is used to kind of more. efficiently manage the flow of funds from investments to cash to insurance. So it looks like it's linked all together. But I would say for most people, they don't really have this. This sounds like something for higher net worth people or people with businesses or something like that. Okay, there's besides banks, the government also offers some savings vehicles. So these are all issued by the U.S. Treasury. You have to go to a special website where you open an account with the Treasury Department. It's a kind of a oldish looking website, but it's not so complicated to figure out. Um, and so the three kinds of government savings accounts that are offered are the I bonds, and these, speaking in 2023, have been actually pretty uh, appealing investments because the I bonds are tied to inflation. Okay, so when inflation is high, as it has been in the last year or so, the returns on these I bonds is really high. So it was worth it to actually buy these the last couple of years, like in the last year or so. They are 30-year savings accounts, and you're locked in for 1 year. So if I understand it correctly, I believe you can withdraw your money within a year, but you forego any of the interest you've earned. Actually, I just checked. That's incorrect. You cannot redeem the money from an iBond account in less than a year. So you're kind of locked in for a year, but then after that, you can take the money out within this kind of 30-year period. So if it's money that you know for sure you won't need for at least a year, uh, this could be a good option, especially right now when inflation is on the higher end. And since it's backed by the government, there's virtually no risk of you losing your money. Um, the government's likely not going to default on its obligations, so it's kind of a good deal in that sense from a risk perspective. The other one is a Series EE bond. It offers a fixed rate of return, but it's guaranteed to double in value within 20 years. So it's not the highest rate of return because if we did the math, basically to double, you'd have 2 to the power of 1 over 20 minus 1. And if you did that math, you would say it's around 3.5%, which is not terrible. Okay. For a savings account to get 3.5% guaranteed over 20 years is not the worst deal in the world. Um, so this is an option that's available to you. And then there's treasury bills, which are basically just bonds. These are issued weekly at an auction that the government conducts, and um, this is it's accessible to you, but typically as consumers, you're probably looking at these two options. Okay, there's other types of savings instruments. A CD is probably the most common kind of savings vehicle, besides like a savings account, which again, the interest rate on savings accounts are really low. So a CD, you get a higher rate of return. The APY is higher, but you have to basically lock your money up for a certain amount of time. So either at least a month, and it's typically at least a year. The CDs that offer the best rates are usually at least a year. So you can get them through most banks, and basically it's pretty competitive. So there are websites you can look at that list all the CDs that are being offered, and basically you can find the one that's offering the best rate. When we talk about credit cards, we'll look at at one of those websites called Doctor of Credit. But for now, just know that you could find this information online pretty easily to see which banks are offering the highest CD rates. What it would basically entail is that you would have to open an account at that bank and then transfer the money and then basically put the money into that CD, and it would be locked up for however long the CD term was. So it does take a little bit of work to like shop around and find the best rate. Um, but it could be worth it if, especially if you have a larger amount. Okay, commercial paper, basically, it's similar to the U.S. Treasury, but they're from companies, so they are offer a higher rate of return. This is again something probably through a brokerage account you may encounter, but I think for most people, you're probably not going to directly be investing in commercial paper. Banker's acceptance, I don't think this is really a thing anymore. It looks like it's about the same as a CD, so I don't think this is really a common thing anymore. And then a money market mutual fund. So again, this is similar to the money market. Basically, through a brokerage account, they're going to put your money into this, and it will buy these short-term securities. And it's basically a portfolio of this kind of stuff, the commercial paper that's professionally managed.